If this sound brings back memories, congratulations, you've just time traveled. But if your money habits still live back there, then we need to talk.
You could program your VCR to record Seinfeld, but are you still programming your money like it's 1999? Did your money advice come from a time when your biggest financial fear was a Tamagotchi dying? If so, you're in for a wake-up call.
I'm Jonah.
And I'm Jeremiah. Together, we're the Banking Bros. And this is the Money Moves Your Mama Missed. The series where we rescue your wallet from outdated advice, one myth at a time. This isn't about disrespecting our parents. It's about acknowledging that the world's changed. The advice they gave came from one place of love, and it made sense for their time. But the rules of the game have completely shifted.
Today, we're asking a simple question. Have your money rules kept up with the world around you? Because the planet got Wi-Fi and crypto and robo-investing and the save and spend system. But some of us are still clinging to myths our parents heard of on AM radio.
We'll rewind to see why mom's advice did make sense. Fast forward to why it falters now, and most importantly, show you the upgraded playbook so you can build wealth in 2025 and beyond. Because while her intentions were pure, the world she saved money in is not the world we're living in today. Let's start back in '79. Gas lines curled around the block, inflation hit double digits, and cash in a savings account earned over 11%. Telling you to save every dime wasn't fear, it was free money. You could literally make a profit by just parking your money in a bank. It was a no-brainer.
By 1994, 5-year CDs still paid out 4%, and that's not bad for parking cash. Now let's fast forward to 2025. Big banks wave around 0.1% like it's a favor. That's not saving, that's snoozing. Today, putting your money in a traditional savings account is a guaranteed way to lose purchasing power due to inflation.
Here's why. Mortgages averaged 13%. Credit card APRs flirted with 20%. If interest was a riptide, the safest advice was never swim. It was the kind of debt that could easily drown you. The risk was so high that it made sense to avoid it at all costs.
But here's the kicker. If you knew that those same homes would triple in value over 30 years, then a fixed rate mortgage looks a whole lot less like a noose and it's more like a catapult. The house was an asset and the debt was a tool to acquire it. But with interest rates so high, it's a terrifying tool to actually use.
The 401k saved corporate America from pension obligations. Fees were microscopic, or so they claimed. So funneling every retirement dime there seemed logical. The market boomed, dot-com mania made millionaires overnight. It was the golden age of the stock market, and the 401k was the vehicle to get in on the action.
Then dot-com reality checked for everyone, right? The bubble burst. Fees are not so tiny, and volatility felt like a roller coaster with no lap bar. People saw their retirement accounts drop by 50% or more, and they learned the hard way that a 401k is not a magic bullet. It's a tool with its own set of risks and its own set of fees. Inflation averaged just above 2% in the last decade, but healthcare is up 5%, tuition 8%, and eggs don't even start. 8-track advice just can't outrun Spotify speed costs. The financial rules your parents were used to are just based on a different economic reality, honestly. Trying to apply them today is like trying to drive a horse and buggy on a modern freeway.
Mom bought this house at 8.8% interest, 1995. She hustled to pay it off early. Sounds noble until you stack it up against the S&P's 300% climb from 1990 to 2020. She saved roughly 90 grand in interest, but potentially missed out on hundreds of thousands of dollars in market gains. Opportunity cost is invisible but brutal. She traded a predictable savings for a massive potential gain. And that's a trade-off that doesn't always make sense.
Meanwhile, today's phones outpower NASA Apollo computers back then, right? Yet we still treat plastic like nuclear waste. Credit cards at 22%? Yes, toxic. But 0% financing on a revenue-generating asset? That's leverage. That's not poison. The key to distinguish between good debt and bad debt. Good debt puts money in your pocket, right? Bad debt takes it away.
The 401k landmines. Early withdrawal penalties before 59.5, Medicare premiums keyed to taxable income, and required minimum distributions now at 73. Mama never faced this triple threat because life expectancy and tax policy were different. You're subject to a set of rules that were designed for a different time, and if you're not aware of them, they can cost you a fortune.
If you ignore those variables, you may retire with a bigger tax bill than you were working, right? This is why having all your retirement money in a single tax-deferred account can actually be a humongous mistake. The tax man's coming, and he'll come for his share eventually, and he'll be waiting with a much bigger bill than you might expect.
Assisted living now averages 70 plus grand per year, and long-term care insurance costs more the longer you wait. Outdated rules leave no line item for getting older. Your parents' financial advice didn't account for the massive increases in healthcare costs that we're seeing today. You need a financial plan that's built for the 21st century, not the 20th.
So let's put mom's favorite rule to the test here. You put 10 grand in a CD in 1995, that's 4%. By 2025, you'd have roughly 26 grand. Now let's adjust that for inflation. If we do, you're left with about $15,000 in today's buying power. So that's a 50% loss in purchasing power over 30 years. I don't think that's a win, that's just a slow defeat.
Same starting cash in a properly structured whole life policy, guaranteed base, plus dividends could cross 42 grand while staying liquid and tax advantaged. It's not just about the raw numbers, it's about the quality of the dollars. Dollars that are liquid, tax-free, and accessible without penalty are worth a lot more than dollars that are tied up in a CD or retirement account with a bunch of rules.
Now let's plug in housing. Mom's early payoff saved her $90,000 in interest, but it actually left her with zero liquidity when opportunities knocked. So if you run the alternative, right, you invest excess principal at 8%, you pocket far more and you still own the house. It's just on schedule. You have to think about the opportunity cost of paying off the debt early. Is that money better used elsewhere? The answer actually is often yes. But our parents' generation, your parents' generation, was taught to be afraid of debt, so they never even considered it.
Leverage works for you when returns outpace cost. That's Finance 101. But fear of debt rewired too many brains. We hand you the gavel so you can judge each debt on merit, not myth. You have to look at each financial decision from one modern perspective, not an outdated one.
4% withdrawal assumes a 60-40 portfolio, but research says that actually 3.3% is way safer. And then if you add long-term care expenses or elder care, sometimes people call it, the safe rate might be 2.8 if you add that in, which I think the translation is if you double your nest egg or you either rethink the whole formula. I don't think you should rely on rules of thumb that were created in a different economic environment entirely. You need a custom modern plan that's actually built for your specific needs.
Rethink we shall by adding alternate streams, policy loans, real estate cash flow, royalty income. Diversifying how you get paid beats diversifying where you park money. It's about building multiple streams of income that are resilient to market swings and economic downturns. This is the new financial playbook. Step 1, liquidity. Cash you control, not the bank, not Wall Street. High yield savings for 30-day needs. Policy cash value for mid-range moves. This is the money you can access without penalty or credit checks. It's your personal rainy day fund, your opportunity fund, and your emergency fund, all in one.
Step 2, growth. Assets that beat inflation after tax. I am talking index funds or small cap tilt, maybe Bitcoin if you can have that and sleep at night. I'm definitely talking about the save and spend system because that dividend scale belongs in there too. It's growth locked in by guarantees, and that to me is the chef's kiss. It's about building a portfolio that's designed to grow over the long run, regardless of what the market is actually doing.
Step 3, leverage. Fixed rate debt, lower than inflation, loans from your own policy, even student loan refinancing if it frees up cash flow. Use debt tools, don't let them use you. Your parents fought death with a sledgehammer because they only saw the liabilities. We hand you the gavel so you can judge each debt on merit, not myth.
And yes, we still love mom. Mom, if you're watching, hearts, right? But she didn't have these cubes, these rates, this data. The world has actually changed, and so should your financial strategy. The good news is you have access to a wealth of information and tools that your parents never had, and that's a huge advantage. And we're here, and hopefully one of those tools, so we can help you use it.
Meet Carla, 35, teacher, inherits 60 grand. Mom says CDs, play it safe. She locks in at 2%. 10 years later, inflation chews half the buying power. She has more money in her account, but she can't buy as much with it. She's stuck in a time-traveling portfolio that's losing value every day.
Okay, so then we've got an alternate Carla, right? And let's say that this Carla uses our save and spend system. So she pumps in premium, she borrows then 40 grand at a year 4 or so to buy a duplex. The rent on the duplex covers the loan interest, covers the condo fees, and by 10 years in, the policy is still growing. It's been growing the whole time. The duplex has appreciated, and Carla's net worth can triple compared to CD Carla, right? Or, her twin sister or something. The same starting cash, but it's 2 different timelines. One was stuck in the rules in 1995, and one was living in 2025.
The moral of the story is this: you have to use the right tool for the job. And the tools your parents used are not the right tools for today's financial landscape. It's time to upgrade your financial toolkit and build a future that's designed for success.
In one of our next videos, we're gonna tear apart the all debt is bad mantra. We're gonna show you how credit card traps and 5 ways good debt can actually hand you a raise. We'll show you how to use debt as a tool, not a trap. We've got all sorts of videos planned.
Then we'll dissect the 401k chokehold, the down payment obsession, and whether paying off your mortgage early is genius or madness. We're going to tackle all the big financial questions that your parents had to deal with.
So if any of this hit close to your pocketbook, right, then you should subscribe. Subscribe to our channel, seriously, like now. Every week we're actually putting out new videos, and we'll replace some other those dusty rules that you've heard with modern money moves. So don't let your wallet continue wearing parachute pants.
Smash like if you've ever balanced a checkbook with mom in the kitchen, and drop a comment. Which rule do you suspect is sabotaging your future? We want to hear from you.
And if the save and spend system sounds like your upgrade, your path, then click the link in the description. You can book a free call. Either myself or my brother will be the ones to chat with you, and we want to give you some upgraded advice, right? It's like giving your money fiber optic speed, you know what I mean? And not dial up. Peace.